Okay, thanks guys. Welcome to our first report back for the year. Thanks for joining us. I'm sure we'll have some other guys coming in, but if you can just keep your mics on mute, that will help us, and more than welcome to turn your screen off if you want. Essentially today we're just going to be speaking to two of the fund managers that are sort of managing equity building blocks within Seed Balance Fund, just to get their views. Often when we have these feedback sessions, we give our views, which is, I guess, a second-hand view of what the underlying managers are telling us. But we thought it's a nice way to maybe start the year to get the news from the horse's mouth. The agenda today is just a brief overview of why we like local equity, and then Chantelle, Baptiste from Fairtree will be speaking to us on their outlook, and then Patrice, Moyal and Douglas Wallace from Visio will be chatting to us on their positioning. And then hopefully we'll have a bit of time at the end where any questions that you guys have, you can ask directly to them. So just from our side, we've got within the Balance Fund end of January, we fairly overweight our sort of strategic asset allocation to equity. On a valuation side, we see a lot of opportunity, but at the same time, we understand that it is going to be definitely a stock pickers market. So we are overweight local equity. We do see good value there, but I think importantly for us and in our portfolios, we see that the managers are adding value. We have two established boutique managers, both been around since 2003. We benefit both from a focused range and stable businesses. So these are, while they are boutique style managers where the owners are sort of still majority owners, or so the managers are, still majority owners of the business, that have large assets and they have no issues in sort of terms of going concern. These two managers have very different investment styles. And that's why we speak to you guys often about blending managers together, and within the Balance Fund we make sure that we blend managers with different styles together, so that when one's struggling, the other one's doing well, and vice versa. And finally, I guess there's always talk of active versus passive, but in these two managers have been in our portfolios for a long time. They've both delivered nice alpha since inception. So we just kind of want to reiterate that where it makes sense, active managers can and do add value to client portfolios. To introduce Fairtree, so they were established in 2003. They're an owner-managed firm with assets under management of 115 billion rand and over 40 investment professionals. The equity capability, which was launched in 2011, has won multiple Raging Bull awards and been managing a portion of the Seed Balance Fund for nearly 6 years. A large component of the team's success has come from their ability to marry top-down or macro analysis with savvy bottom-up or stock selection. While their process has resulted in a return profile that is more volatile than the market, they have added over 7% alpha per annum net of fees since they added to the Seed Balance Fund in mid-2016. Chantelle, Baptiste, our presenter for today, joined Fairtree over 5 years ago after 5 successful years as a sell-side analyst. She's a portfolio manager and analyst in the equity team that manages 85 billion rand. Over to you, Chantelle.
Thank you to the Seed investment team for hosting us this morning, and to Visio, always a privilege to present here. And welcome everyone. Go to the first slide, please, Mike. So from an outlook perspective, we believe 2022 is going to be dominated by quite significant global forces. These are the 3 key themes that we're looking at. Obviously, this is fluid and dynamic and it can change. But for us, it's very important to have a view on the globe. We have a very externalized equity market, so what's happening in China, what's happening in the US is very important to us. So key themes, we're looking at central banks. We are of the view that global inflation is going to remain higher for longer, especially in the US, and we're going to try and understand what central banks are doing. At the moment, it seems as though the key central banks are all singing from the same hymn sheet, so we're going into a hawkish tightening type of stance. And this is to try to contain the inflation. But thus far, the Fed has been guiding that inflation will be transitory and it will pull back. From a growth perspective, your 2 single biggest economies, being China and the US, are moving in opposite directions. At the moment, the US is busy tightening, starting to take liquidity out of the system, and it's starting to hike. Also coming off a very high growth base, and that growth is starting to roll over. This is very different to China. China has been in a tightening cycle. They're starting to loosen policy, stimulate and encourage growth. They're trying to achieve 6% GDP growth during the course of this year. And they're also facing quite a significant committee meeting in November this year, where Xi Jinping wants to be named leader for life, but he has to demonstrate economic strength and growth. What's different now is that China does matter. China's a $16 trillion economy. So what they do does matter. It's not 2008 anymore, where you could put sanctions on China and it wouldn't really make that much of a difference. The world feels that, and we felt that through the lockdowns. When China switched off their manufacturing capabilities, it had a huge global supply chain knock-on, which we're still feeling today. Then lastly, geopolitical risks will be heightened this year. Everyone's keeping an eye on Russia, Ukraine, and also there's a lot of tension between China and Taiwan. Go to the next slide, please, Mike. This is what's been happening from a global perspective, and I look at your key economies out there. So at the top, olive and black, you can see how the US and the Eurozone are coming off a very high base. I'm not saying that the growth is going to roll over. It's just going to normalize somewhat. China, on the other hand, at the bottom in the orange line, they have been below your 50 PMI mark, and they're starting to recover. Next slide. What the Fed has been doing is they've been stimulating hand over fist. So the black line there is a proxy for the US economy, equity market, the S&P 500. And the orange line there is the stimulus that the Fed has been pushing into the system. QT is quantitative tapering. It's when they start to tighten and they start to remove, and QE is when they stimulate. You can see when we hit 2020, March in the pandemic, they stimulated significantly. And you can see how that's favored the equity markets. Net inflows into the US equity markets is also a huge underpin for a much stronger dollar. On the next slide, you can see how we started this year with the Fed starting to say that they're going to be taking that liquidity out the system. There's not going to be as much money in the system, and there's a potential for that money not to be free anymore if we start to hike interest rates in the US. I've used a few of the meme stocks that have gained a little bit of attention and called it a bit of a froth index. I could throw cryptocurrencies in here too, but you can see how that orange line is pulled back significantly. So what we've seen is if we're going into a tightening cycle in the US, your speculative trading is starting to dry up. It's where a lot of the retail money's gone into, a lot of the algorithms, a lot of momentum trading. That's the first part that will be impacted, but there is a chance that if the Fed tightens too quickly and too much, it has an impact on the NASDAQ and the S&P 500. You have to keep an eye on that. Next slide. We look at what's happening from an inflation perspective, and sorry, I haven't updated it. That's that orange line there where it says 7%. The US inflation, the most recent print now is actually 7.5%. But that is what the real inflation is. So that's what's happening on the ground. 7.5% US inflation. The black line is what the market is pricing in. The market is saying, we think it will gravitate back to 2.4%. So the market right now is not expecting significant amounts of inflation. They're saying that it will normalize, it's transitory, and it will come back. We oppose this, and we think that there are key underpins at play that is going to keep inflation higher for longer. Next slide. This is a ratio, and you're looking at US debt to GDP. So it's a ratio, it's not in absolute terms. But the last time we saw the US have this quantum of debt on their balance sheet was just post the Second World War, where the world was under pressure. The US had spent a lot of money on the war. And what they decided to do then is inflate their way out of the problem. They let inflation run hot. They invested a lot into infrastructure. At the same time, the USD became the reserve currency of the world. And they really pulled down, from a ratio perspective, their debt to GDP. So higher GDP, higher growth, but a similar level of debt. If you fast forward to 2021, you can see that we're back at these eye-watering levels where debt to GDP in the US is reaching 134%. The question now is, what will the Fed do? Will they let inflation run a bit hotter for longer and try and inflate their way out of their debt problem? Or they start to ratchet up their interest rates? Bear in mind, at the moment, they're paying very, very little on this debt. It's money for free. If you start to increase the interest rates on that debt, they're going to be paying for that money. So it's just a conundrum that we think the Fed is facing at the moment and trying to understand if perhaps they may be a little bit on the back foot. Hiking rates is not the end of the world. It's how quickly and how many of these we see. On the next slide. Because of this view that we think global inflation will remain higher for longer, and bear in mind, I'm not calling for the 1970s inflation double-digit type of print. I'm saying that inflation could move from very, very little to 3, 4, 5%, and that's a significant increase off its base. We've positioned for a bit of protection in our fund, and we've looked at the global industrials, the dividend plays, Anheuser-Busch, as well as BTI, British American Tobacco. You can see from a valuation perspective, on the far right, the two olive bars there, trading at very favorable multiples. They also add a ZAR hedge, a Rand hedge to our fund, so protecting in case we go into an environment with a stronger dollar and then emerging market currencies obviously come under pressure. Done well for us, and we've taken quite a significant position there. Our gold position also adds a little bit of defense to the fund. You'd want to be in real assets if we're going into a higher global inflation environment. Next slide. And then moving on to geopolitical risk, just a neat picture I picked up from The Economist. You can see that China and Russia have started to become friendlier. And this isn't an all fall down scenario, but the question is, what is China's long game? And they do play the long game. So we saw this passive aggressive tension starting under the Trump administration from 2016. We saw the trade wars come through, and thus far it has been passive aggressive. It hasn't been a hot war. Russia going into Ukraine, we're not quite sure what their stance is. It seems as though they're making a lot of noise, making the US look a little bit worried. Obviously, the US troops are there, but we're trying to understand what is China's long game. So if China's push is to have world dominance and to be the next superpower in the world, they're probably going to be making alliances with certain geographies and countries. Russia would make sense for them. They're very, very minerally endowed. They produce oil. There's 100 million barrels of oil that are consumed daily. Russia produces 11 million barrels of that. Saudi is the other big producer, and the US through Shell is the other big producer. So Saudi, Russia, and the US contribute about a third of the world's oil production. So making friends with them would make a lot of sense from a China perspective. China also has been looking at Taiwan, been making a lot of passive aggressive moves. And the reason for that is that they're one of the biggest semi-chip conductor producers in the world. So there's a lot of power and value there. You go on to the next slide. So this is where we think that China really matters, especially if you're an emerging market commodity exporting country such as South Africa. At the top there, the orange and the black line, that's steel production. China produces 50% of the world's steel production. And what they did during the course of last year is they decided, because they have a vulnerability, because they are net energy importers, they're going to push quite hard for greener energy. So Xi Jinping said to the steel producers, we don't want you to produce more than 10% than you did on last year's base. So a lot of the steel production had to switch off their capabilities and reduce steel production. Now, in basic economics, when you're producing something, supply and demand dynamics kick in. If the demand stays at the current level, but the supply of steel starts to drop, it pushes the price of steel up. But at the bottom there, that black line, that's iron ore. That's one of the biggest inputs into steel. And that fell off a cliff. And we sat back and we scratched our heads because it didn't make sense. If the incentivization is to start producing steel because the price of steel is going up, all the marginal producers around the world based in Sri Lanka, Pakistan, India will start to pick up that steel production. So we thought it was a timing issue and iron ore would start to pick up again. And that is what has happened this year. And we're getting quite nice returns from our positioning in general mining. Another factor was the Beijing Winter Olympics, where Xi Jinping had to demonstrate to the world that he does have green skies. We do think after February, we'll start to see a little bit of a kick in steel production. Next slide. Energy prices are through the roof. So you can see there in orange, that's thermal coal. In black, it's oil, and then natural gas in olive. But they are pushing up at the moment. And just as an aside, a very interesting factor for us is from an ESG perspective, a lot of these assets, you're not allowed to invest in them anymore. Coal is a very good example of that. It's seen as a dirty commodity, and nobody must invest in it. And these large mining companies are starting to spin out their coal assets. Anglo America spun out Thungela, and now no one can touch it. Thungela is trading at a 30% dividend yield at the moment, 130% free cash flow yield. That means that Thungela is generating 130% of its current market cap in free and available cash, after it's paid taxes, after it's paid all of its expenditure, after it's paid its stay in business capex. It's very powerful for that company. It has a lot of dry powder. 80% of the world's global energy is still being produced by fossil fuel. That is not going to turn off overnight. So what we're doing is we're marginalizing these assets. We're pushing the fossil fuel components out into the private sector, and we're actually removing ourselves from it. I'm not quite sure if that's the best ESG approach. Next slide. And this is just an interesting, it's obviously taken back quite far. It's over the last 120 years. It's a global company we subscribe to called Gavcal. And Charles Gav said that he believes oil moves in cycles. The blue highlighted bars, that's when we've had high inflation. You can see in the 70s we had very high inflation. And it's normally predetermined when that red line peaks through and it breaks through that level. And he's pointed out those points in time. And that happens when you're having oil starting to accelerate or energy costs starting to accelerate and equity markets pulling back. So there's never, ever been a period where we've had inflation from a global perspective and energy was cheap and rising less quickly than equity markets. Right now, if you fast forward to 2021, we are having energy prices going through the roof and the equity market is starting to pull back. Next slide. From a greenification perspective, copper is quite a key green metal. And just another food for thought, we're trying to understand where all this copper is going to come from for all the EVs, for all the batteries, for all the wind and solar panel, for all the hydro out there, because it all consumes a lot of copper. The olive line at the top, that's the demand for copper. I've taken it out to 2030, and it's very conservative basis. You can take it out to 2050, but I struggle to forecast tomorrow, let alone up to 2050. And the black line there, that's the amount of copper the world can produce. And you can see the divergence and the lack of supply. Now, interesting on the left, those blue bars, that's expansionary capex, and you're looking at global copper producers here. So it's how much capex they've put into expanding their current operations. What happens in a mine is when you start to run out of the metal, you mine the periphery, you mine the shafts and the like. So your grade drops, but you've got to spend a lot of money on that. The orange bars at the bottom, that's how much exploration capex has gone in to find new mines. So all that means is a geologist is sent out into the middle of nowhere, and they come back and they say there is a copper ore body underneath the ground. You don't mine it. The numbers at the bottom are the number of ore bodies that we found from a global perspective. So you can see in 2011, we found 6 copper ore bodies across the world. For the last 5 years, we haven't really found much. And the problem also is that these ore bodies are sitting in very obscure geographies, like Papua New Guinea, where there's 1,000 official languages, where people still eat each other, where the government keeps changing. Harmony has tried to get a license to mine their Wafi Goldproof project there since 2011. It's now 2022. Another big, rich copper geography is the DRC. Again, a very difficult jurisdiction to get these mining licenses. And once you have the license, it will take you a minimum of 5 years to build the infrastructure to get the first ounce of copper out the ground. So if we need to put copper into all of the greenification that we need in the world, where's it going to come from? So we have the view that copper prices could hold and probably go north from here. Next slide. And then I think this is my last slide. I love a picture because it explains things quite neatly. And what I've used here is just a proxy for what I was talking about, looking at the auto or car manufacturing sector. So we have to move away from ICE, internal combustion engines, and that's the orange box that I've put there, gasoline and diesel, and we're moving into a world of hybrids, electric vehicles, and fuel cells. Now, what's interesting here is you can see at the bottom in copper, so the CU, look how much copper goes into your traditional vehicles, 20 to 25 kgs. If the whole world is going to EVs, that's going to take 75 to 80 kgs. It's threefold what we're currently putting into cars. And the question is just, where is that all going to come from? Another takeaway from the slide, you can see the PGM space at the bottom there, that's palladium, platinum, and rhodium. How much goes into a traditional autocat, so 2 to 5 grams. How much goes into a hybrid, a very similar amount, and absolutely nothing goes into an EV. And that's where we had the scare in the PGM sector over the last few years, saying that the whole world's going to turn to pure EVs overnight, and we will not have a demand from this industrial metal going forward. Next slide. And then lastly, just an overview of our positioning. So what we are looking at right now into 2022 and how we're reading the tea leaves is that your two biggest single economies are moving in opposite directions. In the US, you have higher inflation, a potential for the Fed to make a mistake and hike rates too quickly. So long duration assets, your long duration assets are your equities that have got cash flows far out into the future. And right now, they're not that profitable. They normally trade at very high multiples. They will come under pressure, your speculative equities. Some of your tech stocks could come under pressure, but I just caveat with saying that within that tech space, there's some big names that are actually very, very profitable. They're cash flow positive today. Amazon is an example of this. Microsoft is an example of this. So I don't think you can paint all of these with the same brush, but there will, if there is an equity market correction, it will probably come through in the tech sector, and that's a huge chunk of the NASDAQ and the S&P 500. From a China perspective, they're opposite. They have very low inflation at the moment. They're starting to loosen their rates, and they're stimulating. They're pushing credit into the system. They're becoming a lot more amicable from a regulatory perspective, supporting the property sector, for example. So we think growth would come through. If we have a higher growth coming through from China, that would benefit most commodity exporting countries such as South Africa. So we have a position in commodities. We like 10 cents at the moment because it's diverged from its peer group in the US and it's come under a lot of pressure. So we still have a position through NASPAS and Process there. And then we've added some defense to the portfolio through Anheuser-Busch as well as British American Tobacco. And that's it.
Thanks very much, Chantelle. Some food for thought in terms of, I guess ESG is quite popular, and I guess a divergent views on how ESG is best played. So thanks for your views there. Up next we have Visio. Patrice, Moyal, and Douglas Wallace are going to be presenting from Visio's side. They form part of an investment team that is 18 people strong, boasting a diverse range of backgrounds and skill sets. Visio was also founded in 2003 and currently manages just under 40 billion rands of assets across a range of mandates. Visio has been managing a portion of the seed balance fund for over 10 years and has delivered excellent risk-adjusted returns over this period. Visio prides themselves in their ability to uncover stocks that are off the radar screen and will not hesitate to engage with the board if there's a possibility to unlock value for investors. Visio is unashamedly a bottom-up manager with a slight value style bias, and given this process, can protect clients on the downside. Over the 10 years that our mandate has run with them, they have outperformed the market by over 1% per annum net of fees, while capturing only around 50% of the market's downside, and is therefore a perfect fit for a balanced fund. Patrice is the founder and CIO of Visio and has been managing investments for over 25 years. Douglas joined Visio over 15 years ago and has a corporate finance background. Over to you guys.
Thanks, Mark. Can you all hear me? Okay, great. Firstly, thank you to Seed for the opportunity to present your clients. I think it's quite an honor on our side. Thank you. And I like what you said about food for thought from Chantelle, especially after she mentioned that in Papua New Guinea they eat each other. So that's definitely food for thought. Okay, Mark, maybe there are quite a few slides. I know you've taken some out, so perhaps just scroll down and I'll tell you where to go, because I know you've mentioned performance. Okay, very briefly, I'll touch on a few. We've only got 20 minutes, but this explain. I don't want to go spend too much time on last year because it's done. But what you can see is the light blue colors is the stuff we held. The black is what we didn't hold that did very well. This is just the top 40. We've got an array of smaller things that aren't in the top 40. And then on obviously the ones that didn't perform are on the left, and you can see there's a few we hold. So there's technically, you could say there's a fair amount of embedded value still in the stocks we hold that have yet to perform. And it doesn't mean that we've sold. We've only actually sold Investex in terms of those big performers. We are still very overweight MTN for a number of good reasons. Mark, if you don't mind going to the next slide. From an offshore perspective, no doubt it's a lot more challenging. And bottom up is very difficult because we're not in every country. So we tend to direct it via themes, and then from the themes we identify interesting opportunities. From time to time there'll be the one-offs. We will find something interesting that may not technically fit in a theme. So in a nutshell, we've done well on some and we've done quite badly. The ones where we haven't done well, and to Chantelle's point, is in China. And we hold these stocks still. We haven't sold. In fact, we've bought more at lower levels. I'm a China bull. I have been for a long time. We've made a lot of trips to China over the years, dying to go there again. There is just so much going on there, and obviously, as Chantelle said, a geography that one just cannot ignore. There's just too much demographic dividend there, too much organized business, too much organized processes, and the pool from a commodities perspective, the pool from a consumption spend, the pool from a technological advancement aspect. I mean, they are installing 5G towers faster than the entire world put together every month. And the upliftment of, when you're talking 1.3 billion people, and with a rounding error the size of Australia in terms of population, with roughly what they describe as roughly 300 million people being what they classify as middle class out of that 1.3, with an expectation that a further 300 million will reach that middle class status in the next 9 years to 2030. That's what they refer to as common prosperity. And in every respect, it's the right thing to do, much like we have government grants that at least keep some people above ground. They have no choice but to ensure common prosperity. And that, in essence, will be a very strong driver of ongoing spend, consumption, development, etc. in China. We've been invested in Yum China since 2018. This is the largest fast food chain in China. It's Kentucky, it's Pizza Hut. It's actually up this year, 8%, notwithstanding a pretty difficult set of results. But one of the phenomenal, unbelievable, one of the best run companies in the world. Same could be said for Tencent, same could be said for a few other stocks that we hold. We're continuing to learn, we're continuing to put a few pegs in the ground there, and some of it will be healthcare, obviously media and social spend through Tencent, and no doubt food consumption through fast foods because they are completely underpenetrated, etc. So these are just some ideas, but it's not an exact science, and we are going to make mistakes along the way. But at least we haven't blown the portfolio through anything like, as Chantelle said, there's many stocks where you really could have drilled holes into your portfolio by getting carried away. Mark, if you want to move on. Thank you. So portfolio positioning, to get in a nutshell, unfortunately, it's just a 15 stocks. Seed have got line of sight on the entire portfolio and often quiz us on some of the things we do there. And I can say that if we had more cash, we'd have a lot more things. We really are finding enormous amounts of opportunity, both locally and even some offshore. And to the commodities theme, we also would like to have more in commodities. We're actually upping some of our commodities, more specific, less on PGMs, but certainly more on industrial metals. We're completely on the same page that industrial metals have got a very long, sustainable growth vector. You can see it even in iron ore. No matter how much iron ore they're pumping out, they cannot get more than 20 to 30 million tons more of iron ore on a 1.1 billion tonnage type volume. 2-3% is basically as much as they can pull out, and even Vale's numbers last week were actually slightly negative. So it is challenging to get the stuff out the ground in most of these industrial metals. And listening to Glencore yesterday, you're really the masters of these industrial metals are the big groups. We've got some Glencore in seed now. We've got more BHP than what's reflected here because we hold some on the London line too, so it's actually double the weight. But as I said earlier, notwithstanding that, we're finding a lot of value elsewhere, and we're quite challenged in terms of spreading that portfolio. You'll also find that it's relatively, maybe if you go to the next slide, sorry. Maybe just in terms of sector positioning, it's fairly well spread. So again, not too much concentration in any particular place. As Mark said, we are unashamedly bottom up. So the bulk of these will be bottom up. There will be theme driven, but it ranges from everything technology, given it's just so prominent in every respect, to industrial stocks. So that's the likes of a Motus, which is vehicles, and a few other companies that fit in that category. Packaging is quite big, only because some of the stocks have done really well for us. SEPI, which we are selling down now. We got in the throes of COVID because it's a balance sheet. We've known Douglas and I since 2009, since we bought those first dollar bonds back in 2009 after the crash. At 7, I mean, we've known that, we really know that balance sheet. We know the old players at SEPI. So we took a view that balance sheet would be in a position to actually weather the storm, and they have. Packaging also includes Nampak. It's not there in the top 15, but you would have been quite challenged buying Nampaks, and it was raining Nampaks when we bought them from many institutions, and we, across our funds, hold over 12% on Nampak. It's only 1% plus of the funds. It's almost doubled. In fact, I see this morning it's got a 4 in front. We bought it with a 2 in front. And by all accounts, they are pumping volumes at capacity. Nigeria, Angola, to a lesser extent Angola, and they are flat out in South Africa. Again, maybe just if you move on to the next slide, sorry, it will give you, there we go. Sorry, this will explain things a little bit better. Special opportunities is where Nampak falls, and that's on the top block there on the right. Now, these are few and far between, and when we do find them, we will stick to those for a while. We will work with the board, we will work with the management, we engage, we WhatsApp them, we really get involved. And we send sometimes letters of commendation, other times it's emails to really compliment the board, compliment the management, and thank them for what they've done. And we wouldn't have been able, we're not in the trenches like they are, and we must take nothing for granted. And I can tell you, Famous Brands, we've done that. Nampak, we've done that. Forbes, we're continuously engaging with them because it's still very much undervalued. And SEPI, it's certainly one we've had to do less there, except worry about the balance sheet and the liquidity situation. But they've been very engaging over the last couple of years, to the point where we've been comfortable having a decent position there. So these are special opportunities. There are quite a few more in the portfolios right now. Some have already come to fruition, but there's a lot, something like a Netcare, which is below domestic champion. That stock is still half what it was pre-2018. It had other issues which they've dealt with, and a business that is substantially better than it was pre-COVID, a balance sheet that's in good shape, and as we all know, and Seed have heard us talk about this for a long time, private healthcare is an essential element of an economy. Very few stocks are still in the toilet. Netcare is one of those. We actually picking up a bit of Mediclinics, and we've also got some life healthcare. So we're wanting to be well spread there. How we also break down our idea set is really just always, we will have those champions internationally. And I'm not going to go into each one in detail. We're not going to have enough time. But needless to say, they are sometimes the backbone of the portfolio. Mondi's have been a holding we've had for over 10 years. Last year didn't do anything, but it's still generating huge amounts of cash. It is exceptionally well positioned in Europe around online, and they are the biggest producers of kraftliner, which is what you put your online purchases in these boxes, etc. So it's fully integrated, fully self-sufficient, with a balance sheet literally in showroom condition. In fact, we are pushing for special div or a bit more of an aggressive buyback. So these are just some of the pillars that generally we will continue to hold and expect 10 to 15% in hard currency year in, year out. On the growth opportunities in SA, talking bottom up again, so this has generally been our niche, is that mid-cap space. So Advotech, if we'd panicked, we would have sold them at roughly half of where they are now. But they were at the level they are now pre-COVID. So, you do have to know these companies well. We were instrumental in bringing VCP onto the board. We sold some shares. We convinced Coronation and Gray to sell some also. It gave Value Capital about 6%. They bought some in the market. We gave them about 3 or 4. They've got a good guy on the board now. They've also reshuffled the board. Education is an eminent theme in this country. Private education, unfortunately, is the default option for so many people, certainly those that can afford it. Kuro is also one that is highly cherished, so much so we can't find shares. We've been on a buying program for 6-7 months now. I think we got more than 4% of it, and unfortunately PSG holds 60%, so it's really like a hen's teeth to get these. And we're overpaying, but we know that there's an embedded upside here for many, many years. It's a cookie cut approach. You put the classrooms down, you put the bricks and mortar. Year one, you're filling up grade R and grade 8 together. Second year, it's those move up a grade, and then you're bringing in new kids. So it's this ongoing embedded upside. It's almost like a life insurance company with embedded value that you can actually quantify. And as that happens, so the de-gearing starts. So these are gems, and there are only 2 in the country as far as size and liquidity. So best that we keep those. Advotech, by the way, is bigger in tertiary than in schools, with Varsity College and Vega and Rosebank College, and they're expanding into Africa. So these are just some growth, and we call them growth because there is growth. There's organic growth in these, and the market does reward growth. Mid-caps, unfortunately, have not enjoyed the same rating as many others, and when there's times of turmoil globally, the mid-caps kind of become neglected, and then we do trail the indices. But then over time, you get your return. And if you're in the right companies and you're engaging, you will have at least a bit of an edge locally. So there are others over here. MTN, we haven't sold down. MTN had an incredible. We've been in MTN. In fact, we were short MTN in our hedge funds. We went long during COVID. Again, around the balance sheet. The whole issue was de-gearing, the dividend payout, etc. The balance sheet was very stretched. They couldn't get money out of Nigeria. When you assess all the pros and cons and you look at its embedded customer base in Africa and all the things that could do from within, it just made absolute sense to get involved in that 40 and 50 rand level, which we did. And to this day, we still hold decent positions. There is a lot to come out of MTN on this continent. If you may have picked up how many SPACs have raised money in Europe and in the US to go and find fintech groups in Africa. And there's no doubt that MTN fits that bill so perfectly. Mike, if you want to go to international, I don't think we've got much time left, unfortunately, but that's the way it is. Yeah. So very quickly, investment themes, there are so many. We've tended to focus on the ones where we can see longer term returns and maybe not try and call the bottom or the top on certain shares. We've invested in some in demographics, so that's a Yum China. Fits the bill perfectly on the top left. Energy transition, we had First Solar, we did very well. We traded out of those after a while. We might get back in now. We traded out of those 20% higher than where they are now. Biotech, we haven't quite got that one yet. We're looking, but there's just so much transition and mutation going on around food. And then obviously the digital age, and there's no shortage of stocks there. You have to be in Microsoft. You must be in Alphabet. And there's obviously a number of others that are highly prominent. TSMC, no doubt. Samsung to a lesser extent. All of these Koreans are driving us mad because they don't think like most shareholders do. Unfortunately, they live in another world in Korea. We've even sent letters to the investor relations people to get them to send them to the execs to list the company, do an ADR in the US, things like that. And we put a whole argument together. But we're not going. They're probably wondering who the hell are we down there in South Africa. That was Samsung. It's very cheap. Sorry, I was going to scroll down. Maybe one more slide, Mark. Thank you. So this is some of what's on our radar, or in our offshore fund, our offshore dollar fund, and in our hedge fund. So, and it's just quite a range. this has not been a day's work. This has been going on for a number of years. We've been in Chubb for a long time. We've been in and out of First Solar. I mentioned Yum China on the left for a long time. We're even putting money in Intel, notwithstanding the difficult, the next 3 challenged years they're going to have, but what they'll build will be phenomenal. So these are just some, we can go into each one in quite a bit of detail, but these are just some of the stocks that we've been either monitoring or that we invested in. Yeah, Mark, I think I'm going to leave it at this so that there's time for questions. Thank you. Can you maybe leave it on this one? One of our favorite stocks.
Yep. Patrice, you've got a couple more minutes if you want.
Oh, have I? Sorry, I didn't know that. Okay. Well, then maybe go to the one with the countries, where the spread of countries, because that gives you a decent idea of what the seed fund is holding. And you can see that it's fairly diversified from Visa, getting back into normal conditions, although we have held Visa throughout the COVID environment. First Solar is not in the portfolios now, but we model this thing. We know what's coming. We will be back in it. It's the largest producer of solar panels in the US, and with the aversion to anything Chinese, First Solar is very well positioned. They've got plants in Thailand. They are doubling the capacity in India, and they're not doubling, they're adding another 30% in Ohio in the US. So they are extremely well positioned. Just the stock for the next 12 months is going to be, the returns will be slightly subdued while all that capacity ramps up. In Europe, cars, we like these boring Daimlers and VW, and we'd love to own more of them. They are really cheap. They're going through a transition. They're on 5s and 6 PEs. We haven't put Stellantis here, but we have it in other funds because we can't pass the 30% offshore limit. But we'd rather be, and they're paying out 4 or 5% euro yields, at least in dividend yields. And Chubb is another one. It's the second largest reinsurer in the world. It's Swiss-based, but it's an American management team. They've done phenomenally well. We got in at $94 at $208, and we got in two years before COVID. So these are some of the stocks that are really good long-term producers of return. Superdry is an opportunity. It's been up and down. We did very well. It doubled, and now it's back to almost cost or a little bit higher than cost. So we're monitoring that one, but a good balance sheet. And then obviously the ones I've mentioned in China. Again, we're prospecting there slowly because it's quite an interesting geography with lots of government regulations, etc. And we've seen how much damage that can do. Very difficult to call global markets. One day Russia's going to invade, the next it's not. I'm kind of think Putin took some long positions in oil, sent a few of his toys across the border in Ukraine, made a bit of noise. All he wants is that little top part of the East Ukraine anyway, and makes some noise that those engines run, and then oil price goes above $90, and now they've probably banked there. Maybe they're going short oil futures now. So I don't know. I think it's very tricky calling global markets. As I said, we'll be a bit more granular if we can.
Great, thanks, Patrice. So thanks very much for speaking to us. I think just maybe just for the advisors out there, our mandate with Visio does allow for them to invest in both SA and to a certain extent global shares. They do have team members sitting over in the UK and in Australia, and as Patrice said, they have been doing global stocks for a while. I think maybe from both of these presentations, what you can appreciate is how the two managers look at things very differently. While they both agree that China is very important going forward, from Patrice and Visio's side, they're looking at typically bottom-up opportunities, consumer side, whereas from Chantelle and Fairtree's side, they're looking more top-down, trying to understand how China's move from a macro side is going to influence potentially commodity markets and the like. But what they can agree on, I guess, is the importance of China, and are both fairly positive on China. So again, these are two great managers. We've held them for both of them for a long-term period. They've both been able to deliver, but essentially doing things differently, they're able to blend nicely for each other, and hopefully within our seed balance fund give us a more consistent return stream. Arjan, I'll hand over to you now, if that's okay.
Thank you, Mike, and thanks so much, Chantelle, Patrice, and Douglas, for those very insightful presentations. Guys, we've got a wonderful opportunity to ask questions while we've got these three fund managers online. So you're welcome to either type them in the comment section and we'll pick it up from there, or you're welcome to just unmute and ask it outright. T-Man, I know you've put your hand up. You've got a question that you want to ask.
Yes, Adrian, if you can allow me to kick off the question section. This is a question for both you, Chantelle, and Patrice. I think a key decision that advisors have to make is allocating either offshore or locally. So the question really is on the case for local equity, just to understand if you think there's an opportunity set there, especially given the fact that you've got fairly weak economic growth in South Africa. I mean, we always hear about the shrinking JSE in the papers. And obviously, if you look at our political environment, it's generally weak. Is there an opportunity, or is there a case for local equity, especially if you look at the offshore opportunities or the offshore decision that we have to make in either allocating locally or offshore?
Patrice, can I go first?
Yeah, sure, go.
Okay. So I think at Fairtree, we have maybe a bit of a different way of looking at it. We are 100% invested in the JSE. We have been since inception. So for the last 10 years, the alpha that we've been fortunate enough to generate has been from opportunity sets within the JSE. And the way we look at it is that, and as I said at the outset of my presentation, we have a very externalized market. A huge chunk of the revenue that your top listed companies are generating are from sources outside of South Africa. So it's a mining company that has an asset base here, but it's selling a commodity in a hard currency to someone consuming it outside of South Africa. Or it's the access that we have to your big global industrials, like a BTI, like a Anheuser-Busch. It's access to Chinese gaming, to Chinese edtech. So because of that, we have always found opportunity sets within South Africa. That said, our mandate allows us 30% offshore allocation if we want to. We haven't had to access it thus far. If opportunities had to dry up here, then we would look at that. But we're specialists in this market. So, you could always use Fairtree as a core and then add, an offshore complement to it through a passive or an active type of manager. I also think that the mistake people make is they look at the JSE and they say that is SA Inc. But SA Inc. is one chunk or one sector within the JSE. You have resources, which is very broad brushstroke. Within that, you've got a whole bunch of subcomponents, which are very much uncorrelated. The drivers behind gold are very different to the drivers of PGM, very different to the drivers of oil and gas, paper and packaging, copper, cobalt. So they all move differently, and that's a huge opportunity set within itself. You have offshore consumer exposure, and you also have a defensive sector. In the SA Inc. part of the market, which is predominantly your banks, your hospitals, your retailers, your industrials, your property groups, they also aren't 100% SA focused. A lot of the retailers will have operations offshore, the industrial companies as well. But if that part of the market is under pressure, which I'd argue it has been relatively weak for the last at least 5 years, because we have been on a slow structural decline. There was a rebound during the course of last year, and as Patrice pointed out, there were a lot of opportunity sets within South Africa where you could have doubled your money because it's coming off such a low base. But even going forward, if you have the view that we're going to have very pedestrian growth in South Africa, 1 to 2% GDP growth, we still think you can access other opportunity sets. But that's just our view.
Thanks, Chantelle. Maybe very briefly, Mark, if you go to one of our slides, there's a little thing there with a triangle, well, three-pronged story. There we go. Okay. Very briefly, I'll touch on this, but there are targeted picks. We're not taking a broad brush and saying SA is good or SA is bad, because quite honestly, we also quite challenged by what we're seeing. But you can direct your positions, your investments at things that are either essential, and then look at the metrics of those companies. Mobile spend. I actually met with somebody who's the second largest reseller of mobile airtime for Vodacom yesterday. And the intel that he gives us on what's going on the ground and when they run out of airtime and who's doing the stuff. And I mean, there's insatiable demand for airtime. And then data, and also, and obviously smartphone penetration is tiny, and in Africa it's even more shocking. So you can just imagine how much upside there is in a country like Nigeria with 230 million. 170. Yeah. Anyway, there's, you know that Nigeria could have more fintech subscribers than there are banked individuals in South Africa. South Africa's population is 55. What are there? Maybe 30 million people with a bank account. Now, if MTN gets their act together, they could have 100 million people, 75 million people with some form of fintech facility or enablement on their phones, on their smartphones, because they're never going to put branches in Nigeria. Spend's going to be low, but it doesn't matter. It's all incremental. So there's just so much potential. So we do target these things. I mentioned education, famous brands. What a great capital-light business. Fast foods, and they are back at the 2019 revenue, and I see Spur had a good update. But the share price is nowhere near, and they have weaned themselves out of that rubbish acquisition they made in the UK, and the debt's come down by half already. So these are, we can't ignore those. There are no doubt that many more companies are being delisted. We had 26% of ARB. It's going out at $8. We were always struggled for a company to get a better rating, but it's done very well for us. It was up 90% last year. So these things are there. We must take advantage. This game has done well for us. It's a big stock. Next year, as I mentioned, it'll come right. So we won't let those things pass by, and at the same time, we must be cognizant of the challenges. That's the best way to put it.
Thank you very much, Chantelle and Patrice. Chantelle, next question is for you. In terms of one of the three micro trends that Fairtree sees playing out in the market for the year, the one was sort of the inflation interest rate story. And you guys have got the view that structural inflation is going to be here for longer, and that potentially the market's then not pricing in enough of those future interest rate hikes. What does it mean? I know you're more defensively positioned. The US is pricing, I think, about 7 hikes at this point in time. Do you foresee them hiking more than that, or higher increments than the normal 25 bips? And what will it mean for investors? Is it going to bring more volatility, more downside in the months to come? How do you see it playing out in 2022?
It's a great question, and something we're also trying to figure out ourselves. So I'll say very much upfront, I'm not an economist or a macro strategist. So I don't spend a lot of my time trying to predict the exact quantum and number of hikes. So I can't give guidance there. We'll look at what the market's saying and try to understand. Our concern is that the Fed has been a little bit on the back foot, and they are a lot more reactive. And inflation at 7.5% is quite it's high relative to where it's been. And we just worried that it's a bit of a knee-jerk reaction. So if they approach it sensibly and they allow for it to run a little bit hot, and they maybe give it a little bit more color, because remember, the Fed's been very Teflon. They've changed their tune a few times, and they said last year that they're targeting a long-term inflation rate of 2%. They don't give a lot of granularity to that. So with pressure from other central banks ex-China, like the BOE and in the Eurozone, them being very hawkish and already starting to hike, we just worried that the Fed moves too quickly and in short concessions. So I can't give you the exact number and how much, but if they do that, yes, there will be a hell of a lot of volatility, and you will see a correction in equity markets. What often happens with that is it's a knee-jerk reaction. And another conundrum you have is that 50% of money invested in the US equity markets is passive. It's a lot of algorithms. It's a lot of momentum trading. So as high as those equity markets can go, and remember, they've been enjoying a very good financial standing US citizen. So the US citizen on average, the consumer in the US is sitting in a good position. They've been supported through COVID, even if they haven't been working, and they've actually been saving a lot of that. They haven't been traveling that much. They haven't been spending it on services. They have been spending it on goods, but there's a lot of goods that they can't get access to. So there's a lack of vehicles globally. There was a lack of smartphones for a while. So they're sitting on cash. They've been investing that into the equity market. If suddenly, especially in the speculative side of the equity market, you see pressure and correction, a lot of that money will start moving out. And remember, momentum money and algorithms, they don't care much about price. They follow direction. So you suddenly get the effect of a pressure hose trying to go through the eye of a needle. And that type of correction is fast and furious and scary. It's what we saw happen in March 2020. Then the dust settles and people start to think it through. Active managers come in and they start setting the prices again. So as much as, yes, there could be volatility, there could be a hell of a lot of opportunity in it. If the likes of an Amazon and an Alphabet and a Facebook to a certain degree do pull back, then maybe that's a great buying opportunity for those individuals that are invested offshore because they suddenly look attractive. Remember, these are companies that are generating proper cash flow. They are profitable and they are taking over. They've reached a critical mass where they can go into any geography now and they can take over. So Amazon coming into Africa, that's a whole new growth driver and growth vector for them. Where we get excited about the Asian stocks and specifically the Chinese stocks is they are starting off a low base. It's very different to the US equity market where multiples are relatively quite high on average. In China, they're relatively low. So you also have to sit back and think, where does the money flow to? Another question for us is also, what's going to happen in the bond market? If DM bondholders are receiving negative real rates, and they have been for some time, does the traditional 60-40 rule still apply? 60% equity, 40% bonds. And if it doesn't, how long do they hold on to negative returns for? And if they don't, remember, money has to go somewhere. So where does it go to? Where does it find a home? Do we suddenly see EM, specifically China, starting to recover and being net benefactors of that flow out of the US markets potentially? Does it go into crypto? Does it go into gold? Does it go into property? So we don't have all the answers, but this is, it's a very good question because it's part of what we're thinking about at the moment.
Thank you, Chantelle. That's a mouthful, but as you say, there's a lot to think about. And potentially, if clients don't have some dry powder, there might be some great buying opportunities, if I understand you correctly, as 2022 unfolds with all its ups and downs that may be in the pipeline for us. Guys, we've probably got time for one last question. If there's any questions, T-Man, another question from you.
I've got a question for Patrice if no one else has anything.
You can take it, Mike.
Patrice, I know you guys, I guess, a sort of one of the value adds that you guys do is looking for these under the radar stocks, which, as you mentioned, typically are sort of smaller mid caps. We know some of them are being taken out. Are you not worried that you buy the share, it's got great upside, and then takeouts come and you don't get your full value? How do you think about that?
Yeah, well, we had that problem with the EPP, where we had to even employ a bunch of lawyers in Cape Town we almost went to court against the JSE there because of the terms of the transaction. There was some obvious omissions in the circular which could have swayed shareholders in EPP. Anyway, so yeah, that one unfortunately was a challenge, but we're going to be getting a mountain of reader funds now, and they're not expensive, so we'll have to live with it. So that was a pity. But we've been successful in others, and we over the years we went Atlantic Leaf, it got taken out, and Redefine PLC. There are a lot of dysfunctional listings still in South. EPP is one, the biggest Polish retail group sitting in South Africa. It just doesn't make sense. Same with Redefine, same with EPP. I mean with Redefine International at the time. We're very big in RMH. That's another dysfunctional listing. It's got its entire properties portfolio. 90% of its value sits in Eastern Europe. Stocks traded here. There are two other large shareholders sitting unlisted. It doesn't make sense. Something has to give. There's 50% upside or 30 to 50% upside in the NAV, and it's a good NAV with good parental supervision in RMH. So these are just some examples. There are quite a few more that are we would call dysfunctional. Nampak Consol was taken out. The biggest glass producing player in the country was taken out. No one's coming in to compete against Nampak. No one's going to come and put down plant. So they do only make a conversion margin. You can't do the PE here, but this stock was $30. it's now 4.15 this morning, and it's all about managing that debt in oil-rich countries, by the way. So it's another way to play the oil market without having to worry about Sasol's daily volatility. If oil goes up, Nigeria is pumping, and the same with Angola. And then their cans that they're producing, they can get the money out. So, yeah, unfortunately, we are the fewer because they're being delisted, but if we can be instrumental in their delisting, well, so be it. We'll get involved.
Thank you, Patrice. Chantelle, Douglas, thank you so much for your time. Thanks everybody for joining us. It's great to have you all on board. We'll chat to you again in the middle of March, and all the best for the rest of the week.